90% of Wall Street professionals, the guys in the $3,000 suits who literally get paid millions to pick stocks for a living, fail to beat the market. Let that sink in for a second. You have an entire industry built on the idea that investing is this hyper-complex, math-heavy science that only geniuses can understand. They want you glued to your screen, sweating over red and green candles, analyzing earnings reports at 2 in the morning. But it is a lie. A very profitable lie designed to separate you from your money. The financial industry thrives on making you feel inadequate. If you think it is too hard, you will pay them hefty fees to do it for you. Or worse, you will get sucked into the hype of day trading, crypto pumps and meme stocks, trying to get rich by next Tuesday. Here is the truth that no one trying to sell you a course wants you to hear. The most consistent, reliable, and mathematically proven way to build generational wealth is incredibly boring. I am talking about a strategy so lazy that you can set it up in 15 minutes, look at it maybe once a year, and still outperform the so-called experts. Today, we are stripping away the Wall Street jargon. We are going to look at the exact blueprint of the boring millionaire. We will talk about why being lazy is actually your biggest advantage, the magic of the S&P 500, and how you can build a financial fortress without ever picking a single winning stock. And stick around, because a bit later, I am going to reveal a sneaky, hidden fee that the financial industry uses, one that could quietly eat up to 30% of your entire life savings if you do not know exactly what to look for. You definitely do not want to fumble the bag on that one. So let us start with the biggest trap new investors fall into: the illusion of stock picking. When you first decide you want to invest, the natural instinct is to try and find the next Apple, the next Tesla, or the next Amazon. You watch a few videos, you read some articles, and you think, if I just find that one company before everyone else does, I am set for life. It sounds amazing. The problem is, picking individual stocks is basically finding a needle in a haystack. Sure, you might get lucky once, maybe twice if you have a good run. But doing it consistently over 10, 20, or 30 years, it is statistically near impossible. Even the pros, the people with supercomputers and teams of analysts, get it wrong most of the time. Think about companies that used to be absolute giants: Blockbuster, Kodak, Sears. If you went all in on those back in the day, thinking they were sure things, your portfolio would be sitting at zero right now. That is the risk of single stocks. You are putting all your eggs in one basket, hoping nobody drops it. So if picking stocks is a losing game, what is the alternative? Instead of trying to find the needle, you just buy the entire haystack. Enter the S&P 500. If you have ever watched the news, you have probably heard some guy in a suit say something like, "The S&P is up 20 points today." It sounds like boring finance talk, but it is actually the ultimate cheat code for the everyday investor. The S&P 500 is simply a list of the 500 largest, most successful companies in the United States. We are talking about Apple, Microsoft, Google, Amazon, Johnson & Johnson. The heavy hitters. When you invest in an S&P 500 index fund, you're not trying to guess which of these companies will win. You are buying a tiny, tiny slice of all 500 of them at the exact same time. Think about how powerful that is. If one company messes up and their stock tanks, it barely hurts you, because you have 499 other companies holding you up. And the best part? The S&P 500 is self-cleansing. If a company starts failing and drops out of the top 500, they get kicked off the list automatically. And a new growing company takes their place. You do not have to monitor the news. You do not have to read financial reports. The index automatically updates itself to always hold the absolute best companies in the American economy. Basically, by investing in the S&P 500, you are betting that the United States economy will continue to grow over time. And historically, despite wars, recessions, pandemics, and political chaos, that bet has always paid off. Over the last 90 years, the stock market has returned an average of about 10% per year. Now, 10% might not sound like a flashy number. It is not the overnight crypto million you see people flexing on social media. But 10% is the foundation of true, lasting wealth, thanks to something called compound interest. Albert Einstein supposedly called compound interest the eighth wonder of the world. He who understands it earns it. He who does not pays it. Compound interest is just money making money. And then that new money making even more money. Let us break down the math, because this is where the boring strategy turns into millions. Imagine you are 25 years old and you decide to invest $500 a month into an S&P 500 index fund. You just set it up to pull from your checking account every month, and you forget about it. You do this every month, rain or shine. You do not panic when the market drops. You just keep buying your $500 worth. By the time you are 65, you would have put in a total of $240,000 of your own hard-earned money. But because of that average 10% return and the magic of compound interest, your account would be worth over $3.1 million. Let me repeat that. You put in 240 grand, and you walk away with over 3 million. That is the power of time. The longer you let your money sit there and bake, the bigger the pie gets. This is why starting early is so incredibly important. If you wait until you are 35 to start investing that same $500 a month, you would only have about 1.1 million by age 65. Waiting just 10 years cost you $2 million in free money. But even if you are starting late, the best time to plant a tree was 20 years ago. The second best time is today. Do not let the fact that you did not start at 18 stop you from starting right now. Now, I know what some of you are thinking. This sounds too simple. There has to be a catch. Why doesn't everyone do this if it works so well? That brings us back to Wall Street and the great Warren Buffett million-dollar bet. Warren Buffett, arguably the greatest investor of all time, has been telling people for decades that they should just buy a low-cost S&P 500 index fund. He constantly preaches that the boring way is the best way. Back in 2007, Buffett got tired of all these fancy hedge fund managers claiming they were worth their massive fees. So, he made a public bet. He bet $1 million that a simple, unmanaged S&P 500 index fund would beat a hand-picked portfolio of elite hedge funds over a 10-year period. These hedge funds were run by the smartest guys in the room. They traded constantly, analyzing every data point, trying to time the market perfectly. Buffett literally just bought the index and went back to drinking his cherry Coke. So what happened? When the bet concluded 10 years later, Buffett absolutely crushed them. His boring index fund returned over 125%. The highly paid hedge funds? They averaged a miserable 36%. The smartest guys in the room lost to the lazy, set it and forget it strategy. And a huge part of the reason they lost brings me to that hidden trap I mentioned earlier. The silent killer of wealth that you have to avoid at all costs. Fees. When you invest in actively managed mutual funds, the ones where a guy in a suit is picking the stocks for you, they charge you an expense ratio. This is a percentage of your total money that they take every single year, just for managing it. A typical mutual fund might charge a 1% or even a 2% fee. 1% does not sound like a lot, right? You might think, okay, I will give them 1% of my profits if they do a good job. But it is not 1% of your profits. It is 1% of your total balance every single year, whether the market goes up or down. Let us go back to our math. If you invest that $500 a month over 40 years, and you pay a 1.5% fee, that tiny little fee will eat up hundreds of thousands of dollars of your potential wealth. It can literally consume a third of your entire retirement fund. You are taking 100% of the risk, putting up 100% of the capital, and giving away a massive chunk of your wealth to someone who, as we just saw with the Buffett bet, probably cannot even beat the market anyway. This is why you must look for low-cost index funds, or ETFs. Funds offered by companies like Vanguard, Fidelity, or Charles Schwab often have expense ratios as low as 0.03%. That means you keep your money, and your money keeps making you money. All right, so we know that stock picking is a losing game. We know the S&P 500 is the ultimate wealth-building machine. And we know we have to avoid high fees. How do we actually put this into action? How do you become a boring millionaire? It really comes down to a simple 3-step blueprint. Step 1. Open a brokerage account or an IRA. Do not let the terminology intimidate you. A brokerage account is literally just a bank account that allows you to buy investments instead of just holding cash. You can go online to Vanguard, Fidelity, or Schwab right now and open an account in less than 10 minutes. It is easier than setting up a new social media profile. If you are investing for retirement, look into opening a Roth IRA. This is a special type of account where your money grows tax-free. Meaning, when you pull it out at retirement, the government does not get to touch a single dime of your profits. It is totally legal, and it is a massive advantage. Step 2. Buy a broad market index fund or ETF. Once your account is open and funded, you just need to search for the ticker symbol of the fund you want. If you want the S&P 500, you look for symbols like VOO or SPY or FXAIX. You literally just type that in, click buy, and boom. You instantly own a piece of the 500 greatest companies in America. You are an owner. You are an investor. Step 3. Automate and ignore. This is the most important step, and honestly, the hardest one for most people. You need to set up automatic transfers. Have your bank automatically send a set amount of money to your investment account every time you get paid. Treat it like a bill. You pay your rent, you pay your phone bill, and you pay your future self. Once that automation is set up, you have to do the hardest thing in finance. Nothing. Do not check your portfolio every day. Do not download the apps that show you flashing red and green numbers. Do not listen to the financial news networks that scream about the sky falling every time the market dips 2%. The media makes money by keeping you anxious. If you are calm, you do not watch their shows. You have to accept that the stock market is going to have bad years. It is going to crash. It is going to feel like the world is ending. In 2008, the market dropped over 50%. In 2020, it dropped 30% in a matter of weeks. If you were constantly checking your account during those times, the psychological pressure would have been unbearable. Your brain, millions of years of evolution designed to keep you safe from predators, would be screaming at you to run away, to sell everything, to protect what you have left. But selling during a crash is the single biggest mistake you can make. It locks in your losses. Remember, when the market crashes, you still own the exact same number of shares you did yesterday. The only thing that changed is the current price someone is willing to pay for them. Think of a market crash like a Black Friday sale on stocks. The companies are the same, but they are suddenly on a massive discount. The boring millionaire does not panic sell. The boring millionaire sees a market crash, smiles, and lets their automatic monthly investments buy even more shares at a cheaper price. They understand that every single stock market crash in United States history has eventually been followed by a new all-time high. Every single one. It takes discipline to do nothing. It takes emotional intelligence to look at a sea of red numbers and trust the process. Most people cannot do it. They get bored. They want action. They want to feel like they are doing something to make money. They start chasing the hot new crypto coin, or trying to day trade options, or buying expensive real estate courses. And they step off the reliable, boring path, and they step onto a treadmill of stress and eventual losses. True financial freedom is not about being the smartest person in the room. It is not about timing the market. It is about time in the market. It is about consistency. It is about understanding that real wealth is built slowly, quietly, in the background of your life. You do not need to make investing your second job. You do not need to understand complex algorithms. You just need to buy the haystack, keep your fees low, automate your habits, and let time do the heavy lifting. If you can master the art of being boring with your money, your life will become incredibly exciting. You will build a safety net that lets you sleep peacefully at night. You will buy back your time. You will have the freedom to work because you want to, not because you have to. And that is what this is all about. Money is just a tool to buy options. So, I want you to ask yourself right now, are you ready to stop playing the Wall Street casino games? Are you ready to step off the hype train and start building real lasting wealth? If the answer is yes, then your journey starts today. Open the account, buy the index, set up the automation, and then go live your life. Thank you so much for hanging out with me today. If this video helped you cut through the noise and see investing in a new light, do me a huge favor and hit that subscribe button. Here at The Wealthy Retriever, we are all about bringing you loyal, reliable, and totally fluff-free financial guidance to help you build your best life. Drop a comment down below and let me know. Are you ready to become a boring millionaire? And I read every single comment, and I would love to hear your thoughts. Stay consistent, stay boring, and I will see you in the next one.